Jonathan, so glad you're with us today. Mortgage professional at Movement Bank.
Yes, sir. Thank you for having me.
And Kyle, financial advisor, financial coach. I know we've been working together for a long time, but we got an interesting topic we want to talk about today, and I'm glad you're here because it's specific to what you do for a living. Definitely not what we do as it relates to specifically mortgages, and it's going into effect May 1st.
That's right.
However, it's already been into effect. But before we jump in, and you start rattling off all your expertise, from my understanding, Fannie Mae, Freddie Mac, they made a rule change, which going into effect May 1st, but I know it might have already gone into effect. That's basically going to be penalizing people who have worked hard to save money to put money down on a house and who have worked hard to establish very good credit north of 680. Is that correct?
That's a pretty good summary. This is something that's been in the headlines for, it's making headlines now because we're coming up on the May 1st deadline. But to your point, it's actually already started because the May 1st date, that milestone, is not for when this rule takes place, but it's for when the loans that get sold to Fannie and Freddie have to have had the rule implemented, which means these are loans that have already closed. These are people that are already moved into their homes and have been for the last couple of months because of the post-closing, mechanics of a mortgage. So you've
been working with this for a while now.
Yeah, we started the hype for us in our industry. I'd say right around February, early February is when it started.
Jeez. And I just learned about this probably a month ago, a few weeks ago, and it just made my blood boil. I'm raised in a home. It's all about the American dream, hey, just work hard, you'll get ahead. And now we're having first a rule, which we'll talk about in a minute. It's not a law, it's just a rule change by an entity which affect an entire industry. And, again, going back to how I was raised, if I work hard and I save and I work on things that are important in our society, I can get ahead. And this is actually telling me I'm going to get hurt.
That's right. It's backwards. And
so how has this affected? First of all, as a financial advisor, we're having to deal with the market going up and down and trying to keep an even keel. We're, hey, it's going to be okay. Financial advisors, notorious being like, it'll come back, and having a good message. So we're going to talk about your message through this, but before we talk about that, let's talk about the realities of what this rule is affecting the industry. So what is the rule, first of all? Like, who started it?
Yeah, let me, I guess, kind of give you a little bit of an analogy. It's almost like if you were going to go buy a car and with your interest rate on the loan that you got for that car was dependent upon your license points. Right? So if you've got a bunch of tickets, speeding tickets and what have you, you've got these points on your license, which, impact your insurance, but not your rate that you're paying on a car loan. Right? So what we're talking about in the mortgage space is very similar as if it would have been these points on your driver's license. Essentially, let's say you get an excellent interest rate because you got 0 points. You're an excellent driver. You've got the good driver discount, right?
Miss Daisy.
But if you have a lot of points on your driver's license, guess what? You're a riskier driver. And so
you're penalized.
You're penalized. You've got a higher interest rate because you're a riskier driver, right? And so what this translates to on the mortgage side is historically, we've always had risk-based pricing for mortgage rates. The truth is that if you're a riskier borrower, you're going to have a higher interest rate. And the risk is assessed by, how much you put down and what your credit score is essentially. So
what's a good home buyer? Like, what's a credit rating for a good one, and how much money down is typically like the sweet spot?
So, before February, I'd say anyone above a 740 credit score was considered excellent in terms of credit.
Does down payment factor?
And then as you put more money down, the less risk you are, right? There's less exposure to the lender.
Which they incentivize, they lower your rates, they give you better.
Correct.
Okay. So now,
generally, that's a risk-based pricing model. And then going back to the car and your license interest, your interest rate for the car loan, what's happening now in this rule that's been applied is essentially me having a great driving record, 0 points. My interest rate is going to now be higher, and it's to make up for the people with a lot of points, who they're trying to incentivize more, car purchases or what have you, right? They're incentivizing that, so they're going to make it cheaper for those people to borrow money on their car loan. This is coming back, and it's being subsidized by the good drivers, essentially.
This infuriates me because, I've got a new driver in my house. He's just turned 17. He's been driving for a little over a year. And, I'm thinking about, I've been pulled over a few times. The vast majority of the times that I got pulled over, I was young and stupid.
Yep.
The older you get, you just get wiser with your stupidity. Yeah. Really. We're still stupid, and I'm thinking, okay, so I've had a clean record for decades now that I've been driving. And now my son's going to go out, make stupid mistakes, the same mistakes that I made, right?
Sure.
He's going to go make mistakes, and then I'm going to get penalized to make it better for him.
That's essentially
That's what this is saying. But in a more grander scale, because we're not talking about a car purchase, we're talking about probably the most valuable thing a lot of people own in their lifetime, which is their house. So we're not talking about penalizing somebody on a $30,000 purchase. We're talking about penalizing somebody on a $500,000 purchase, 300, whatever the number is. It's huge.
Right.
Now, I don't want to lessen, the grand scale of this, but the money behind it isn't humongous. But any type of penalty or fine or fee is for the ones who do it right is wrongly placed.
Absolutely, I agree. And that's what has our industry fired up about this, because the historic risk-based pricing model was that if you got great credit and you're proving that you're a low default risk because you've got good credit and you're putting a good amount of money down. So then there was no premium to charge you. And the premiums would apply to those that historically have a higher default risk, which are lower.
What do you mean?
The premium is the additional cost.
Okay.
And that price that now is being cross-subsidized. So the lower credit score borrowers,
the riskier
borrowers are getting a discount, and that discount is being subsidized by the premiums being charged on the good credit score.
I just want to scream. You're so calm, the riskier.
I've been absorbing this since February.
And I'm like inside, I'm like, are you kidding me?
Yeah.
Like, seriously? So the American dream is basically crashing into a brick wall right now as of May 1st, logistically, because now even if you do things right, you're going to be handicapped to, and I don't want to get too politically polarizing here, about why they're doing this. I mean, that's not really the reason for the show. Our reason for the show is to understand what this is and what workarounds we have.
Right.
But the realities are, as it stands, this is horrible for those who do things right.
Yeah, you hit the nail on the head when you said it's really challenging the American dream, because it's not like a consumer could go somewhere else and avoid this. The reality is that this is being applied from the Federal Housing Finance Agency, which is a government entity that oversees Fannie Mae and Freddie Mac. And Fannie Mae and Freddie Mac, they're the ones that write the rules and the guidelines for all mortgage lenders.
As of my understanding, 50% of all mortgages go through them.
If you've heard of a regular conventional mortgage, a conforming loan or conventional loan, those are two interchangeable terms. You're talking about Fannie and Freddie.
Homeowner.
Yeah, you're talking about chocolate, vanilla. There's not a Baskin-Robbins flavors out there. This is like your basic loan product. A regular conventional loan is a Fannie or Freddie conventional loan. And
what percent do they control?
Well, they control a large percent of the higher quality borrowers.
Well, I asked Mr. Chat GPT last night.
Oh, okay.
And he said,
you may have better data.
He said 50% of all mortgages flow through them.
Okay. And so the challenge with this rule, and I should back up. The spirit behind this is they're trying to incentivize, or they're trying to get more minority borrowers. And I say minority borrowers because what they're doing is, statistically, the folks that fall into the lower credit score tiers are always minority borrowers. And so they're trying to diversify their scope of borrowers inside of the conventional loan product. And that's been...
Hold on. The less fortunate, or the ones that they're going after, or wait, what was, back up. What did you say? Who are always?
The minority borrowers are the ones that are statistically
under 680.
Right. The lower credit score folks are typically minority borrowers. And so it makes up a large percent of that market share, that market segment. And what they found, because they started tracking racial data a little more diligently a couple of years ago. And so reports have been coming out. Now, who's getting the majority of the conventional loans? Who's getting the majority of the FHAs? Or
so this 680 number has something to do with that.
Right. And so it's to spur minority home ownership. But it's putting it inside of the conventional loan bucket and disregarding other loan programs that have historically, and I mean literally almost 100 years. The FHA loan started in 1934. So we're talking about almost 100-year proven track record of being able to help borrowers who have lower credit scores, lower down payments, might be a first-time home buyer.
So then why are they doing this?
They're trying to presumably just gobble up a little bit more of that market share.
By penalizing
the good driver, right? The folks that have, not have any proven record of default risk. Meanwhile, you have the other loan program that is by a long shot just crushing these guys in terms of serving that segment and serving them well. Yeah. Sir, I mean, 5 times.
And we're not even talking necessarily about wealthy people here.
Right.
Because there's certain politicians out there is like, tax the wealthy, go after this is just the average person who is working their tail off, 1 or 2 jobs, building good credit. Those are the people, and the wealthy, that are going to get affected here.
Oh, absolutely. Going back to your son, who's a young driver, he's a higher insurance risk because he doesn't have a proven track record. Well, a first-time home buyer, they could have a credit card for a year or 2, pay it on time. That they don't have that much history, but they will end up with a 780 credit score because that's all it takes, And so even a first-time home buyer with a 780 credit score who's done everything right is essentially paying a tax on folks that have had a proven history of not being able to manage their debts appropriately.
So let me go back to this whole thing that this is a rule. Because this is being controlled by Freddie Mac, Fannie Mae, when they institute something and they control half of the industry, it affects everybody. So the fact that this didn't have to go through Congress, this could literally be a quote unquote business decision. It affected the entire industry.
Overnight. And what's worse is it wasn't a business decision. I think that's probably the most frustrating part about it. Sandra Thompson is the director for FHFA, and that's the Federal Housing Finance Administration. That's a government appointed employee, and she is a lifetime bureaucrat. She's never had a real job outside of government, let alone like a lemonade stand, to know exactly how economics and business works. So she, and her advisors put together this risk-based model to say, we're going to push this out without any trade organizations involvement. Mortgage Bankers Association were not invited to the conversation. These are the guys that are advocating for real estate and financial services across America.
And helping the less fortunate.
And helping, they're huge advocates for housing. Absolutely. They weren't invited to the table. So the government, it basically rolled this out without knowing how it was going to impact Main Street. And you put this in front of my eyes, as a trained loan officer who's dealing with folks and helping them navigate the nuances of qualifying for a mortgage and, pricing interest rates and doing things that we can do to help them every day. And instantly this just sticks out as exactly what you said. I mean, it's really just penalizing those who have done everything right to subsidize for folks that, don't really meet the traditional criteria for a conventional loan.
And what kills me about this is, hey, I'm all about helping those. Like my grandfather came on a boat from Italy.
Yeah.
Like our roots is, I come from a family that broke out of poverty.
Yeah.
So I'm no stranger to this. I look like a white male. Like, I grew with a silver spoon in my mouth, and that is not true at all. But the realities are I'm all for that. But we had that.
Yep.
And now they're taking this idea, this rule, this thought that sounds good. It's like the Robin Hood of the mortgage industry, right? We're going to, hurt these people to help these people. And there's a certain part of me that's like, yeah, let's fight for the underdog. Let's do it. But then there's the other part of me that's like, wait. How are we doing this? Like we already were doing this.
Right.
And now we're just going to do it a different way, but in the process, we're going to damage what was already working very well and giving people incentives to work hard and to save and to help them. And now we're going to hurt them to help somebody else, but we were already doing that.
That's right. Yeah. And what this has done is disrupted decades worth of risk-based pricing models that have a proven track record. And you take the conventional loan product that Fannie and Freddie offer, there's always been this, this matrix for risk-based pricing. And they've offered products outside of a regular conventional loan that are still Fannie Freddie products, but they are catered to a first-time home buyer. It could have a lower down payment component. It may have a more flexible credit score requirement. And their underwriting criteria adjust for that. Now, what's interesting is here on this conventional loan, they've added in this incentive for folks with lower credit scores to not be penalized as much. But at the same time, they've adjusted their inner workings on the guidelines to make it a little bit more conservative and more stringent from an underwriting standpoint to qualify for a mortgage, meaning that if you do have a checkered credit history, it's actually harder to qualify. So they've improved the pricing, but they've made it harder to qualify. And again, there's just other products out there that serve this segment so much better.
And yesterday when we were talking about this, kind of prepping for the show, one of the things that was interesting to me that you said is, in the end, they're still going to pay more than somebody who's done it right. So you have this person that's worked hard, saved, and they have a good credit score, so they're going to pay less, even though they're paying a penalty and they're getting hurt in this stupid rule. Let's just call it for what it is. They're going to pay more, but apples to apples, the one who's coming in at less than 680, who doesn't have the 15% or whatever, they're still apple to apple going to be paying more than this person. Correct?
That's exactly right. Yeah, and that's where I think some of the headlines are missing it, and
they'll pay a little less because this guy's coming to the table, which again infuriates me. But at the end of the day, they're still paying a premium.
You don't want to go out there and ruin your credit score because you're going to get a better rate than the guy with the 780. I mean, that's not the reality.
This guy might be paying 6%, where this guy's going to be paying 8%. But maybe instead of paying 8, it's 7.95 in this situation.
Correct.
Instead of the 8.
Exactly.
It's still way more.
Exactly. And even for that consumer that was, let's say they were getting a 6% interest rate, and this rule hadn't taken effect yet in January. The difference between January and now, the difference is could be, we have a matrix, but anywhere between, let's say a quarter or an eighth of a point to 3/4 of a point difference on the actual price of the loan. So if you take $100,000 loan and you would say, well, what are my closing costs? You'd have your traditional closing costs. And then in January, there would have been no additional premium for the 780 credit score borrower. But as of February, if you were putting, let's say, if you had a 740 credit score, looking at this matrix here, which is the third one down from the left, 740 credit score, and then over to the right, we're hanging out at the 15% down, which is the bright red, if you can't tell what the numbers are there. That 0.75 premium on a $100,000 loan, your closing costs just went up $750.
So what's interesting to me, so you've been working with this since February. I'm going to interrupt it very quickly. So you put together this matrix, and it's a heat map to see, and the red is really bad, and the green is good. So this bottom right-hand corner, which obviously is terrible credit with no money down, right? And this top left-hand corner is, really good credit. And is that more than 30% down?
That is 70% down.
70% down. So if you don't put 70% down and have a stellar credit, you're getting affected. So what's interesting, how long you been in this business?
Coming up on 15 years.
15 years. So you're not green behind the ears at all. You know this business very well. What percentage of the loan business is this red part?
Oh man, that bright red right there, that is the sweet spot. That's the strike zone for a conventional mortgage. Somebody between a 720 to a 760 credit score, putting, in this case it's 15% down, but yeah, anywhere between 5 to 15% down.
So the vast majority of the borrowing public in the United States, so this is 75% or 85%, whatever. You know the numbers, I don't.
Yeah, definitely a higher
the vast majority
percentage for
are
sure.
right here. And this specific rule by somebody who's a lifetime bureaucrat, who's not owned her own business or whoever this person is, they made a rule that affected the vast majority. So the people that do it right are going to pay the biggest penalty. And that is, we're not talking, this isn't the wealth chart. Because the wealthy are up here.
Right.
The ones in this yellow-ish color, or orange-ish, whatever, these are the people that are ultra wealthy. They're not affected at all.
Right.
That part right there, if I'm understanding what you're telling me, the vast majority of the people that are working hard, or ordinary jobs, good credit, with a decent amount of money to put down, they're getting hammered the most.
That's the truth. Yeah, it's unfortunate, but it is the reality. I think that there's still a great argument for home purchasing and getting into the market and being a homeowner.
We're going to talk about that next.
But right now,
pisses me off. Yeah. Like, sorry to say it that way, but that makes me infuriated.
Yeah.
But that's the truth.
It's the truth. Yeah. I mean, it goes back to that, driving record analogy. It's like, if you've got a perfect driving record, then why are you messing with me? I mean, hey, I've worked hard. I've got a clean record. Let me be. But now we're, the folks with your great driving record is paying for my points on my driver's license. So.
All right, so here's where I want to not necessarily land just yet, but I had a call earlier this morning with a client, and the one thing will always be true is that people are going to have to move. People want to move. People want to get a bigger house. They want to downsize. They want to change. They just want something new for no reason. People love real estate. It's not a house, it's a home. I just moved into a rental. We're building a home. And, it was very emotional. Like we cried, even my kids cried, because it wasn't a house. It was a home.
Right.
And we spent a decade there. Our kids, it was hard. So I want to talk about the realities of moving in a terrible environment like this. And the reason I'm going to bring it up this way is, this client that I had this conversation with, they're moving because of their dad, and he's in a bad situation from a health standpoint. And they're like, is it a good time to move? And I'm like, I mean, ideally a year ago would have been great from an interest rate standpoint, but that wasn't the time that really God had for you right now. So for this situation for them, I'm like, if you got to move, you got to move. So I kind of open up the show like we're financial advisors. Sometimes the market goes wacko, and you're like, hey, it's okay. And I know that's going to be your train of thought, because when we first started talking about this, I'm like, get fired up. Like, this rule stinks. Don't give me what you tell your clients. And now we kind of want to talk about what you tell your clients, because at the end of the day, you're going to use the term priced in. So because it affected everybody, you're not going to know. So they're not going to say, hey, before February, here's what it would have looked like. And here's after February, after May 1st, here's what it looks like. And hey, let your blood boil, because this is what your administration did.
Sure.
They're not going to say that. You're just going to say, here's the new pricing. And you're going to go, oh, okay.
Right.
And I don't even know. Do you line item this rule?
Yeah. So I think there's definitely a monthly expense associated with it. in the regards that it's going to change the interest rate, because now you might say, you know,
So
for
is
that
that-
$100,000,
That's the math I was referring to.
yes, because it would impact the rate.
Plus the cost of the buy down.
Right.
Or is that the same thing?
Well, you can forego that additional cost of the buy down and just settle for a higher interest rate. And that higher interest rate would then, it would create a new tier where the cost would no longer be as high.
Interesting. So if you pay up front, it's the same.
That
Or
yes, when you pay up front, you're offsetting the long-term increase in the rate.
And if you don't, so from a financial standpoint, it would be far better to pay the penalty up front than going month to month.
You would probably disregard the penalty
Depending on how
altogether,
long
and
you're in the home.
yeah, because see, this is in addition to whatever the pricing is on the pendulum that day for rates, because the rates have always had a sliding scale. You can pay more interest up front and offset the long-term rate. So if I pay more interest up front, my rate will be lower starting day one. But it costs me something. It costs me that up front.
And if you stay in the house for 2 years, you just made a bad decision. But if you stay in it for 10 or 15,
Right.
you
You
made
hit a
good decision.
break-even point. It's a math equation, right? And
But
so
all rates have gone up.
the rates that's an open market. You know, it's all mortgage-backed
So how does
securities.
this get priced in then?
It's added in as a premium to the cost of the rate, and you wouldn't notice it on a rate sheet. There's no line item. There's no anything. It's what Fannie and Freddie push out, and mortgage-backed securities come out and say, okay, today's market for rates are X.
So in your 15-year experience in this business, when something like this goes into effect, and after September of this year, probably nobody will be even talking about it. Do they ever revert changes like this?
It's set a bad precedent, I think, because we don't know what future administrations will do with our pricing model. And you know, it's been fairly stagnant. I mean, this was a very dormant matrix for a long, long time.
Until now.
Until now. So the last two administrations have done a little bit of tweaking to the matrix, and it's been interesting. You know, the one that really got us was a second home. You know, if you've got your main house and you've got a beach house or a mountain house, and that's for your own personal use, and that's always traditionally been treated as a less riskier loan than, say, an investment property where you're, you know, using it for income producing and income generating purposes. A couple of years ago, they changed the rule for that second home, and instead of these premiums having no additional premium for a second home and treating it like your primary, they now have all the same premiums that an investment property does.
Oh.
Now, you know, life's changed. Airbnb and VRBO are a thing now, and you know what you can do with a second home is very different than what you would have done, you know, 15 years ago.
So they're not treating it as a personal property. They're treating it as a business.
Right.
When did that go into effect?
That started, I believe it was 2 years ago.
So this administration?
Mm-hmm.
Interesting. So when interest rates, not to throw more fire on this, so we saw interest rates just climb out of the trash, you know, in the gutter in the last year, and to add insult to injury, this gets added at the highest rates we've seen in decades.
That's right. And so it's
the
unfortunate.
timing of this is just, why didn't they do this when rates were like 2?
Yeah.
Let's wait till rates get so high and everybody's in shock and like, hey, let's just add more
salt to the wound.
Yeah.
Yeah, for sure. For sure. Well, and you know, you guys are in the financial services space, and you probably say, hey, it's not a stock market, it's a market of stocks, right? And, you know, I think that's where the housing market also has so many different levers to pull on. You know, for example, your clients' conversation that you had, say, hey, is it the perfect time? Well, last year would have been great. You know, rates, or heck, even 2 years ago, you know,
they'll be unaffected.
They were half off.
They don't have a mortgage, but even still, they'd be able to put that 70% down, even if they had a little mortgage. So they'll be unaffected.
Yeah.
And this kind of brings our conversation to a good place where it's turned the corner a little bit.
Sure.
I'm not going to say I'm not going to continue to bash this because I can't stand it. But this matrix right here is kind of a roadmap to a workaround.
Yes.
Because at the end of the day, I don't just want to bash something. I want to help people, you know, learn ways around it. So if if I'm a person that's in this sweet spot, I can either put down a whole lot less and make that penalty way less. And then you're going to come back and say, I'm an expert. Hey, let's put 5% down. We can get you into this loan, this rate. And I'm speaking for you, but this is what I would assume you're going to do. And then after your first payment, let's put the other 20% or 15% down and then readjust your payment. And we're going to ultimately get you where you were without having you to pay 0.75%. It might be 0.25%, but you're going to be able to help navigate a workaround with somebody who's in that sweet spot to get out of that sweet spot depending on their situation. Correct?
That's right. Yeah. This is an open book test. So it gives us the roadmap to where we can, help work around it for sure. And also help consult clients and, say, hey, different strategies depending on what their overall long-term goals are, and sit down with them and try to figure out how long are they going to have the loan? Are they going to have some extra cash? All of those conversations come into play, but
it just adds in another layer of questioning,
right?
As far as, okay, we have the normal stuff we've talked about for decades. Now we got to add in this couple questions about this matrix to understand what would be a good strategy to reduce this new new rule and workarounds for that. Is that right?
That's exactly right. Yeah.
Not that you didn't have enough to work with.
Yeah. I don't want to bore you with even more complex, but there's another side of this rule that even not only incorporates the credit score and your down payment, but then it also brings into consideration your debt ratios. And there's a higher premium that's being applied for your debt ratios.
That you have a lower debt ratio?
And
you are kidding me. Oh my gosh.
It's so complex. And I'm telling you, right now, all the trade organizations are actually fighting against FHFA to pull that out of this rule.
So you save, you work better credit, and you have no debt, and you're going to get the trifecta of penalties.
Yes.
You're the least risky person, and you're going to subsidize all it.
Why did you tell me that? Now I'm even fired up again.
It's even worse. Yeah.
So with all of these different levers that you have and all the different, you were saying, resources that are already there, and then they're moving people, opening up conventional loans. But then you said, but wait, we're going to actually make it more stringent to get this conventional loan. Is the segment of population that they're fighting to help, it doesn't sound like it's really even going to help. Like it feels like the other things that were already in place, maybe the FHA was already
that's right,
a great option. Like why would you even come over here?
They do 5 times more loans for lower credit score, lower down payment borrowers than conventional loans do through Fannie and Freddie. So, they are winning by a long shot. And this is the discounts that they're offering folks inside of those credit score tiers are not going to win their hearts. Their rate is still going to be much higher on this loan program than they would be through the other traditional loan programs that were created and cater specifically for that segment of the market share. And, hey, my first loan was an FHA loan. And I value home ownership. You talk about your parents migrating here, man. I'm a first generation immigrant. I didn't become a U.S. citizen until I was in college. And home ownership is incredibly important to me. My first home was an FHA loan, proudly. It served me well. And through that, I've been able to, qualify and save up, build wealth, and be able to put a little bit more money down to get my foot in the door for other loan programs like a conventional loan that now fit my scale a little bit better. And so there's nothing wrong with being a low down payment borrower. There's nothing wrong with having a troubled, credit season. And so there are great options for those borrowers. This is just missing the mark, in my opinion, in a lot of ways. It's almost like doing a whole lot for not very much impact.
So, help anybody who's watching this understand, there's a lot going on here. I'm super fired up about it. But people still have to get mortgages. People still have to borrow.
That's right.
Very few people can pay cash for a house. So you're such an expert in this regard. If somebody needs a mortgage or needs answers, how do they get a hold of you?
Best way to reach out to me is maybe by email or phone. And
what is it?
So J as in Jonathan, and then my last name. So J Romero at movementbank.com is a great place to reach me.
Spell your last name.
ROM as in Mary, ERO, or at Romero Review on Instagram. You can also find me there.
And what's your phone number?
704-577-3028.
Any final thoughts?
No, I love it. Just I'm with you guys in that like fired up space. I just see my parents who were both teachers, you know, and I know how hard they had to work for that first home. And they, you know, we lived in it for 25 years, 30 years, and that's who I see getting impacted by this. You know, I see it less as help because those programs were already there.
Yep.
It sounds like the help was already there. It just seems like now we're throwing on more weight to people that are.
What's frustrating me about this is in 2 years when this isn't even news anymore, we're all paying these premiums, and this money, I don't want to be a Debbie Downer here, but this money's not going to go to the people that it should be helping.
That's right.
And, you know, there's going to repurpose this money going into somewhere else, and we're all going to pay for it. The people that are working their butts off and doing things the right way. And you might have a trifecta penalty, which I'm glad we didn't talk about because that just makes me infuriated, you know, and for what? I mean, there's that dual thing, like fighting for the less fortunate. I'm all about it. We were them. We were all them. And this isn't, we already have programs for that. And it's not even, if this money would go to like educating and helping, not just benefiting them so they can get a cheaper house, but like, let's teach them how to manage money. Let's teach them how to build credit. Let's teach them how to save and fight for that American dream. Let's not just give them something, because what happens to every lotto winner out there? I mean, 98% of them go bankrupt. You know, like just giving people stuff, we've already proven it just doesn't work. Educating, helping, aiding, coaching, mentoring, that will go so much further. We don't need to do that. Let's just give them money. Yeah, whatever you want to call that. I don't want to get too political here. But it's just, my heart breaks for this because we're going to forget about this in a year and it's not going to go away.
That's
and
right.
We're going to be paying all these premiums. You're going to have to do all this extra work to help people around, but people aren't going to be like you. They're just going to go, here's your rate. It is what it is.
Yeah. It's, you know, there's never a dull moment in our world, that's for sure. But like you said, you know, homes are personal. They really, you know, tug on the heartstrings and they create opportunities for people. And so I do think that the silver lining is that it continues to be a great way to build wealth in America. And hopefully the wealth that's built through the home that you purchase will offset the cost that the government's trying to impose
There's no
on
doubt.
this. And
things won't change. Yeah.
And but yeah, it is very unfortunate and something we'll be navigating the rest of the rest of the
your
year
career.
for sure. Yeah.
Well, thanks for this. This has been great. Very informative. Thanks, buddy.
Thank you.